The Hyliion stock has been the topic of many conversations as of late, and in this video we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is very volatile at the moment, we should be mindful about which positions we assume as well as their individual timing and exposures. Before this video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Hyliion has had a decent run in the recent month, despite being heavily sold off over the past year or so, along with the rest of the sector, and along the rest of the market, I'm tempted to say. There has been quite a few surprises with Hyliion over time, some good and some more intriguing. We know that Hyliion is a serious company developing products that try to solve issues facing the industry, such as higher fuel cost. We also know that Hyliion is one of the few companies that went public during the 2020 era that didn't get involved into massive scandals, such as falsifying sales and reservations or misleading marketing materials to shareholders. However, these didn't stop the share price to fall down along the rest of the sector, and arguably a bit more than many other companies. If we look at, say, the price of Rivian, of Nikola, we can't say that Hyliion, without those scandals, is doing that much better than the other two. I think that the main reason for the price action is that its price rose too quickly back in 2020, and basically allowed the shareholders to benefit a potential capital gain that should have happened over the next few years or even more than a decade. And this caused a massive share dump at some point because the market slowly readjusted to both the new stock price and the new market reality. The market expectations and opinions about the EV sector also drastically changed over the past 24 months, and it's safe to say that Hyliion must prove that it can deliver its products and that they will have a good adoption rate beyond the interesting ideas. Now, let's also take a look at the technicals of Hyliion. The trading volume of Hyliion has recently been 1.7 million shares versus an average volume of 2 million shares. Over the previous 52-week period, its price fluctuated between $2.69 and $12.68. The market cap of Hyliion is currently around $668 million versus an enterprise value of $416 million. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off all the debts. It's worth mentioning that one of the most significant assets for many of those companies are intangibles, which means that they're not items or equipments that you can see or touch, but they're items that can promise a significant growth in the future, such as intellectual properties, marketing brands, and schematics for new products. For many startups, their valuations of those intangibles have been done in favorable market conditions. In concrete terms, what this means is that there can be a huge difference between the market cap and the enterprise value, favoring the enterprise value, giving a false impression to the market participants that a company has been trading at a discount. Now, this is no longer the case for Hyliion, but for a very long time, people were tempted to say that this company is undervalued because they thought that Hyliion basically is trading under its book value, but except this interpretation definitely has its limits, because it's also possible that Hyliion was overvalued in the first place, and that it has only deflated back to somewhere near the reality ever since. And by the way, now it no longer applies because Hyliion's market cap is higher than its enterprise value, which is normal for most companies, especially for startups. Now, as we compare the current price to the historical price fluctuations, the stock is 9% higher than the 1-month low, 35% higher than the 12-week low, and 35% higher than the 52-week low, which allows us to ask ourselves the following question: has the market finally bottomed for Hyliion? Of course, never say never, or never say that this is the last dip before a massive reversal, because we've been hoping for this before, and every time it makes a new low, We hope that this is going to be the last low before some reversal. This may happen, but it really depends on how much appetite for risk the market is going to have weeks, months, and years from now. And it also depends on how many months the company in order to develop its fully electric truck. So we have to wait and see for these before committing more capital. And we're going to talk about what is my overall recommendation for the stock later. On the options market, which often gives us a hint about the market sentiment on where the stock price is likely going to head next, the implied volatility is 85% versus a historical volatility of 75%. The put-call volume ratio is currently at 0.38. It is normal for most stocks to have a higher put option volume than what they deserve, and what the 0.38 means is that there is relatively very little demand for put options, meaning people are not really worried that the stock can go much lower compared to where it is now, which makes sense because it has been flooring or going towards a virtual floor for many months. So I don't think that in the future month, Hyliion is going to further collapse, right? So far it makes sense. In terms of open interest, the most recent volume of open interest has been 63,000 contracts versus a 30-day average of 65,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have the right to either buy or sell the security at a predetermined strike price. Buying the contract gives you the right, and selling the contract gives you the premiums with the obligation to execute those rights if the counterparty chooses to do so. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there's massive demand for put options, maybe the stock is on the up and up. Or if there's massive demand for call options, maybe the stock is going to be like softer or sloppier than the current performance. The reasoning behind this theory is actually quite simple. Because most options contracts or most people trade options would see their contracts expire worthless. In terms of shareholder structure, the institutional shareholders own about 28% of its outstanding shares. The biggest shareholders include Vanguard, iShares, and Renaissance Technologies. It's relevant to understand the shareholder composition of a company as this can help us to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this could be a sign that the stock lacks the depth to justify long-term trust from shareholders. In the case of Hyliion, I would say that it barely makes it to justify long-term holding. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subject to a lot of exceptions since many great companies are mostly held by retail investors as well, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes there could be significant short interest in the total volume, like much higher than your typical percentage, and this can be a sign that there is an organized shorting operation going on, such as what happened with GameStop, AMC, and arguably Redbox. The current short interest is around 11% of the total float and 56% of the transactions coming out from the dark pools. Usually, if the short interest is above 15% of the total volume, and a significant portion of this short volume is coming out outside of the public exchanges from the dark pools or OTC, this could be a sign that institutional positions have been taken to short the stock and that there would be potentials for a short squeeze. That's not the case for Hyliion at the current stage. My recommendation is to keep track of Hyliion and to slowly, very slowly build up a position in the stock and to stay updated on when its truck would be ready for commercialization. The VIX number and the overall market conditions are also very important factors that can determine if your position in Hyliion is going to be successful or not. I would recommend to commit between 1 to 3% of your portfolio in Hyliion, and would also recommend to split this allocation in batches of 10 to 20% at a time so that you can purchase more in case of further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.